Now first look at this question. It is related to Andretti Company, which normally produces and sell 90,000 DAX, and its selling price is 58 per unit. Then unit cost at this level of activity, that is means at 90,000, is as follows: that direct materials, direct labor, and so on. Now what we have in question number 1 is that we have to assume that it has sufficient capacity to produce 1,21,500 DAX each year, and company could increase its unit sales by 30% above the present 90,000 units by increasing fixed selling expense by $1,20,000, and we have to find the financial advantage or disadvantage of investing in this selling expense. So first we need to find out the contribution margin per unit, and contribution margin per unit is the difference between the selling price per unit and the total variable cost per unit. So since selling price is 58 rupees per unit and the variable expense are direct material 7.5, direct labor 9, variable manufacturing 3.6, and variable selling expense 1.70. So total variable expenses $21.80, and the contribution margin per unit is 36.80. So this information is given here in this activity level, and you can find the contribution margin per unit. Now in the question we have been given that we can increase the sale above the normal produce. Normal produce is 90,000 by 35%. So 90,000 into 35% is 31,500 units. Contribution margin per unit we have calculated is $36.20. So we will get the incremental contribution margin, which will be 1,140,300. Now to increase the sales, only we need to spend on additional selling expense, which is given in the question is $1,20,000. So we see that if we produce these extra 31,500 units, we will get a profit of 1,020,300, which is the financial advantage. And on this we don't need to spend any additional fixed manufacturing overhead, only additional fixed selling expense is to be paid. And besides that, we will incur these variable expenses. So thus we can produce this extra unit. Now let's come to the question number 2. These all questions are independent questions. Okay, so sufficient capacity to produce 1,21,500 DAX each year, and we have been given some unit cost also. The customer in foreign market wants to purchase 31,500 DAX. That is the additional we will be producing. And if Andretti accepts this order, it will have to pay import duties on the DAC of $3.70 per unit, additional 28350 for permits and licenses, and only selling cost which is associated with this order only will be $2.70 per unit, which is the shipping cost. And what is the break-even price per unit on this order? So break-even price is the price at which there is no profit or loss. So that means at this we should be able to make up for all the variable cost which will be incurring, because at break-even point the total contribution is equal to the total fixed cost. So only we need to recover the variable expenses. Now let's come to the answer. Now what we will be doing, if we will take up the order, we will be producing the goods, so we need to spend on the manufacturing cost, and the variable manufacturing cost is 7.50, which is the direct material cost, $9, which is the direct labor cost, and $3.60, which is the variable manufacturing overhead. Rest fixed manufacturing overhead cost is not relevant here, and rest are the selling expenses. So we need to only, for producing good, we only incur the manufacturing cost. So that is total is $20.10. Shipping cost has been mentioned, which will be incurring additional on this, which will be $2.70 per unit. Then import duties will be 3.70, and total permits and license cost will be $28,350, which we need to convert into per unit. So this permit and license cost is incurred for the additional 31,500 units. So we will find out the unit cost of this. We will sum of all these costs. This is the total break-even price per unit which we need to recover. Now let's come to the third question. Now company has 700 DAX on hand, and because of some irregularities, these considered to be seconds, and due to the irregularities it will not be possible to sell these units at normal price. So regular distribution element, what is the unit figure that is relevant for setting minimum selling price? So as we know, fixed cost is not relevant because it has been incurred in the past. Only variable is relevant cost. But since we have already produced this unit, we don't need to incur the variable manufacturing cost again. The only cost which is relevant here is the variable selling expense, which we will be doing to sell these units. So that is the only relevant cost here, because variable manufacturing cost has also been already incurred. Product is already manufactured, only we need to sell it now. So the only cost which is relevant here is the variable selling expense. So the relevant unit cost is $1.70 unit. Now let's come to the fourth question. Now in this question it's been told that due to strike in supplies plant, Andretti Company is unable to purchase more material for the production, and the strike is expected to last for 2 months and has enough material hand to operate at 25% of normal sales level for 2-month period. And if the plant is closed, fixed manufacturing overhead cost would continue at 30% of the normal level during the 2-month period, and fixed selling expense would be reduced to 20% during the 2-month period. So first is, how much total contribution margin will Andretti forego if it closes the plant for 2 months? So first we need to find out the units it will manufacture during the 2-month period. So 90,000 is the normal produce. For 2 months it will be 2 divided by 12 because 90,000 units will be produced over the year. So for a year there are 12 months in a year, so we need to find out for 2 months into 25%, because it says in the question that only it will operate at 25% of normal levels. So unit it will produce is 3750 units for this 2-month period. So what is the foregone contribution margin? 3750 units into contribution margin per unit, which we had calculated earlier, which was 36.20. So if we will not produce any units, the contribution margin which will be lost will be 3750 into $36.20, which will come to this. So this you need to fill this information here, the foregone contribution margin, and we need to fill this in negative because any losses reduction should be indicated by a minus sign. So if we do not produce any units during that period, the contribution margin lost will be this much, and we have to fill it in the negative. Now next we need to find out the total avoidable fixed costs. So fixed manufacturing cost and fixed selling cost we will take in total, which is given in the question, is 4,50,000 and 3,15,000. Now this is for a year, so first we need to find it for 2 months. Now how much we can avoid fixed cost, we need to find out from the question. It says fixed manufacturing cost would continue at 30%. So if it will continue at 30%, that means 70% we can save. So we will find the 70% of the fixed manufacturing for 2 months, which will be 52,500. For selling expense, it would be reduced by 20%. It's simply given, it will be reduced by 20%. So we will multiply by 20%. So the total avoidable cost is 63,000, which you need to fill in this box. Now we know the foregone contribution margin, we know the fixed cost saved. Fixed cost saved is as kind of income for us, so it will be put in positive. But since the contribution margin foregone is more than the saving, so there will be financial disadvantage, which we need to fill in this last box. Let's come to the last and final question. So an outside manufacturer offered to produce 90,000 units and ship them directly. Andretti Company accept this offer. The facility it uses to produce dark would be idle. However, fixed manufacturing work would be reduced by 30%. And because the outside manufacturer would pay for all shipments, variable shipping expense would only be 2/3 of the present one. What is Andretti's avoidable cost per unit? So we know avoidable cost is the cost which differs under the two alternatives. So alternative here is that if it accepts the outside offer. So what cost we can avoid if we don't manufacture it? First of all, the cost which we can avoid is the variable manufacturing cost, which we have already calculated for question number 2 also. You can refer there, which is the direct material, direct labor and variable manufacturing overhead. It is 20.10. Then fixed overhead cost total. In the question we have given fixed manufacturing overhead cost is rupees 5 per unit. Since we need to find out in per unit, so we will use the per unit cost, which is 5, and it says it can be reduced by 30%. 30% reduced matlab that can be avoided. So 5 into 3.5 will be 1.5. Then shipping cost. The variable selling expense would be 2/3 of the, no shipping cost would be incurred, and the variable selling expense would be only 2/3 of the present amount. Present amount variable shipping expenses 1.7. 2/3 will be incurred. That means we can avoid 1/3, because 1 minus 2.3 is equal to 1/3. So 1/3 amount we can avoid. So that will be 0.57, which will be rounded off to 2 units. So the total cost avoided is $22.17.
15 के बीच में एक नंबर बताइए। 8। मैं अभी आपसे 8 दिन तक बात नहीं करूंगी। फिर से नहीं, फिर से चलिए 1 से 100 के बीच में एक नंबर बताइए। चलिए मैं आपको देखती हूँ अभी।